Good morning. I'd like to call this hearing to order, and I think we'll get underway. I don't know if you're all familiar with this place, but we got votes this morning at about 10:30. So we'll just go, and we may have to let out for a few minutes and reconvene after votes. We're not expecting a huge vote series, but it'll probably be 20 or 30 minutes, just so you all know what's heading our way. Let's just start off and dig in. I'll try to get through some of this rapidly. Small business access to capital has always been a top priority for this committee. Access to capital gives small businesses the resources they need to keep the lights on, purchase inventory, pay their employees, expand their businesses. For decades, small business owners typically went to their local community bank to receive this capital. These banks were the backbone of how main streets across this nation were created. However, the amount of community banks in the United States has fallen dramatically in recent years, and regulations such as Dodd-Frank have made it more difficult for small businesses to acquire loans through traditional means. Therefore, many small businesses have had to resort to other means to acquire capital. One private sector solution that has grown considerably in recent years to address this credit gap is online lending. While it's difficult to estimate the size of this industry, online lenders originated an estimated $5 to $7 billion in loans to small businesses in 2015, and it is expected to become a $50 billion industry by 2020. While this is an emerging industry with several types of business models to assess risk, mitigate lender exposure, and obtain the capital to lend to small businesses, online lenders typically offer smaller loans with rapid approval and funding times. This morning, we will hear from a distinguished panel of witnesses who will give their perspective on recent trends in the small business online lending industry and how it fits into the overall small business credit market. I appreciate the witnesses being here today. Thank you all very much for coming. I look forward to your testimony. I now yield to the ranking member for his opening remarks.
Thank you, Mr. Chairman.
Dwight Bett.
Access to capital is critical to the success of small business. However, obtaining conventional credit can be particularly difficult for many small firms. Lending requirements are much tighter now than they were before the financial crisis, and small businesses, especially startups, are still considered a risky bet by many lenders. Although Fintech provides significant advantages, there are some drawbacks. Fintech lending platform reserves the right to reject small business applications, just like traditional banks. In 2014, the Federal Reserve found only 8% of business loan applications are acceptable by the larger platform. Today's hearing will provide members with an opportunity to learn about the online lending market and how it has helped increase access to capital for small businesses. Today, many firms are turned to alternative lending that operates on online lending platform. These services have made hundreds of millions of dollars available to small firms by offering a number of benefits over traditional sources, but do have some drawbacks. I look forward to hearing from our witnesses on ways to improve the marketplace and increase access to capital for the nation's job creation and innovation. Thank you, Mr. Chairman. I yield back.
If committee members have an opening statement prepared, I ask they be submitted for the record. I'd like to take a moment to explain the timing lights for our panel today. You will each have 5 minutes to deliver your testimony. The light will start out green. When you have 1 minute remaining, the light will turn to yellow. And finally, at the end of your 5 minutes, it will turn red. I ask that you try to adhere to that time limit as best you can. And with that, we'll get off to our testimony. Our first witness today is Mr. William Phelan, the president and co-founder of PayNet, Incorporated in Skokie, Illinois. PayNet provides small business credit data analysis to a variety of clients. He also serves on the Advisory Council on Agriculture, Small Business, and Labor to the Federal Reserve Board of Chicago. Thank you for being here this morning. You are recognized for 5 minutes. Thank you.
Thank you, Mr. Chairman. Thank you for that introduction. The financial crisis, as you all state, disrupted the credit markets. Traditional banks, as you mentioned, and even large banks were preoccupied and didn't find lending to be as profitable. Fintechs jumped in, as you said, Chairman, to fill the credit gap, but they have their own challenges as well. Let me just briefly talk about the credit conditions for small businesses right now. There's less investment being taken by small businesses right now. From the period 15 to 17, the small business investment is actually down 1% versus 2005 to 7, where it was up 12%. Having said that, the financial health of small businesses is extremely strong right now. Their days past due are actually better than they were before the recession. Very briefly, let me just mention the size of this market. It's important to understand the sheer scope of the small business credit market. We estimated over $1 trillion in total credit. Banks make up the biggest portion of that, about $700 billion. Commercial finance, about $250 billion. And alternative finance, or fintech, is about $5 to $7 billion right now. Briefly, you mentioned the banks and the challenges they've had. They undergo a credit process. The credit process is one of 28 different steps. It can cost a bank $5,000 to $7,000 to complete one credit application. So it's a very expensive process for a bank. And then they have to spend a lot of time actually reviewing those loans, and that's another $1,000 of cost. You mentioned the credit gap as well in your opening. I'd like to point out that Harvard Business School conducted a research study called The Decline of Big Bank Lending to Small Businesses, the Dynamic Impacts on Local Credit and Labor Markets. This was conducted by Jeremy Stein, an ex-Fed governor, and two of his colleagues. And what they found was that fewer businesses expanded employment as the large Big Four banks pulled back on providing access to capital. These were unemployment rates rose, wages fell, the effects were concentrated in industries like manufacturing, and small banks, non-bank finance companies, and fintechs jumped in to fill that gap. And so there's evidence of this shown in this Harvard study. Wages are still lower, that still persists, which means there's more work to be done. You mentioned in your memo the size of fintech at $5 to $7 billion, so I won't dwell on that. They do make traditional loans. They make working capital loans. There are several coalitions that have banded together to make disclosure available, like the Innovative Lenders Platform Association, the Responsible Business Lending Coalition, and the Electronic Transaction Association. And they've all instituted disclosures to help understand the cost of this capital. Very briefly, I want to point out the credit quality of the type of a business that uses fintech. We've seen that credit quality improve from 2009 to the current through 2016. The credit scores were about 660 back in 2009. They're about almost 670 now in 2016. We've seen the fintechs actually increase the balance of the loans that they're providing small businesses. So they were around 20 in the 20,000 size. Now they're at the $65,000 size. We've seen them expand the length of the loans that they're providing. These were very short-term loans, 6-month type loans. Now they're average of 15 months. We've seen the businesses that they lend to is actually longer established businesses. This was really interesting in some of the research, that they're lending to businesses that have been in business for 10 or more years to the tune of about 70% of their borrowings go to those kinds of businesses versus 77% for banks. And they're expanding into diverse industries. We're seeing lending into retail, healthcare, a combination in foods, construction, professional services, wholesale trade, transportation, administration, and manufacturing. Very briefly, we at PayNet conducted a study. We looked at what happens to businesses that borrow from online or fintech lenders. And we see that about 80% of them have actually kind of climbed that credit ladder and actually seen their credit and their financial health actually improve over that time frame. So that was an important finding that we had. But we also note that there's a long way to go for fintechs to be successful. They've done a good job with the technology, but they still have work to do on acquiring accounts, on finding access to capital, and they're on the road towards this disclosure, which I think is an important part of what they've got to do to further bolster their business models. With that, I'll wrap up my comments. Thank you.
Chairman Bratt, Ranking Member Evans, and committee members, thank you for the opportunity to present testimony today regarding financing through fintech, online lending's role in improving small business capital access. I am here today on behalf of the Commercial Finance Coalition, a group of responsible finance companies that provide needed capital to small and medium-sized businesses through innovative methods. Small businesses face a gap in credit availability. Commercial Finance Coalition member companies are trying to close this gap and help spur entrepreneurship so more Americans can own and operate their own businesses. In my testimony today, I will provide an overview of the types of financing available to small businesses, with an emphasis on some of the more innovative financing options. I also will address existing regulation on small business, which is sufficient to protect small businesses. First, small businesses need choices. Small businesses benefit from having different types of financing available. A business owner who is planning for longer-term capital needs may choose to apply for a loan guaranteed by the Small Business Administration. These SBA loans are relatively low cost. They range typically from $25,000 to $5 million. To apply for an SBA loan, the loan applicant must submit a business plan, and the business owner must often use her house as collateral for the loan. In contrast, a business owner who has short-term capital needs may choose to apply for a loan from a non-bank lender or to sell future receivables to a merchant cash advance company. These types of transactions are typically higher costs than traditional SBA loans and are in smaller dollar amounts. To apply for one of these loans, or MCAs, the applicant usually must submit bank statements showing several months' worth of revenue, and the business can receive funds in a matter of days. MCA companies, these are merchant cash advance companies, are primarily balance sheet funders who have an interest in the success of the business. MCAs are also unique because they allow the merchant to adjust the terms of the transaction to match their revenue. Whatever the type of financing a business owner chooses, banks alone are not addressing the needs of small business. Other financing sources are finding success because small businesses demand them. This demand shows that small businesses are being underserved by the traditional funding sources. The MCA and commercial lending spaces are sufficiently regulated by existing federal and state laws and regulations. Both MCA companies and commercial lenders must comply with laws and regulations affecting nearly every aspect of their transactions, from marketing and underwriting through servicing and collections. Even when they comply with every applicable law and regulation, small business funders must also be wary of the Federal Trade Commission's powerful authority to prevent unfair or deceptive acts or practices. Commercial lenders must comply with additional federal regulation, and many states subject them to comprehensive licensing and regulatory schemes. For example, on the federal level, commercial lenders must comply with the Equal Credit Opportunity Act and is implementing Regulation B, which prohibits discrimination against protected classes of people in the extension of credit. The Equal Credit Opportunity Act and Reg B apply to business credit and provide protection specifically for business borrowers. Another example is the Fair Credit Reporting Act, which requires a funder to have a permissible purpose to pull a consumer report for a sole proprietor or for an individual guarantor of a business transaction. This is particularly relevant in the world of small business finance, where the business is often organized as a sole proprietor, or the individual owner will serve as a guarantor in the event that the business defaults. Finally, many states require a license to make a loan to a business, limit the interest rates lenders may charge to business borrowers, or both. And with state licensing programs comes regulatory oversight. States that regulate lending also typically limit the terms of loans, require disclosures in loan documents, and limit the fees that creditors may impose. Most state laws regulating lending apply to loans with smaller dollar values, and these are exactly the types of loans upon which small businesses rely. I'm very optimistic that fintech and alternative finance will fill the void for those underserved by traditional banks and financial institutions, providing much-needed access to capital for small businesses. Thank you.
Thank you, Ms. Fisher. We appreciate your testimony as well. Thank you very much. And I'll now yield to our ranking member for the introduction of the final witness.
Thank you, Mr. Chairman. Our last witness is Mr. Dwyer, CEO of the company is Medinian. Did I get that right?
Mirador.
Mirador Finance in Portland, Oregon. Mr. Dwyer received his ABA in history, literature from Harvard University before receiving his JD from Stanford University Law School. Thank you for being here this morning, and you may begin. Thank you, Mr. Dwyer.
Chairman Bratt and Ranking Member Evans, thank you for the opportunity to testify today. It's really an honor to be here. As mentioned, my name is Trevor Dreyer. I'm the CEO of Mirador, which is a small business headquartered in Portland, Oregon. Mirador is a white label third-party service provider working with regional, mid-sized, and community banks, credit unions, and nonprofit CDFIs. Mirador is dedicated to the proposition that regulated financial services companies want to serve small businesses in their communities. Mirador is not a lender. Our platform focuses on improving the engagement and experience between borrower and lender, supporting commercial term loans, SBA-backed loans, working capital lines of credit, commercial real estate loans, and small dollar loans. When a borrower goes to one of our customers' branches or to their website to apply for a business loan, they're routed onto the Mirador platform. However, they likely won't even know they have left the bank's site, and we want it that way. Borrowers can follow simple steps to fill out the application, and Mirador technology completes a credit memo by pulling additional data from public records, credit bureaus, accounting software, bank accounts, and the IRS, which is returned to a bank's loan officer with a simple indication of creditworthiness based on the lender's credit criteria. We are paid for every credit memo we complete without regard to the final outcome of the application. The benefit to our bank customers is a vast reduction in the time and cost to process the loan. For the borrowers, they benefit from an equally steep reduction in the time it takes to go from the application to the funding of the loan. As we grow our client base, we're creating a network of partners, borrowers, and lenders, passing along customers to ensure that any small business can gain access to credit from a regulated institution without having to go through the time and trouble of starting the application process over each time. This is also a unique way to increase awareness of low-cost lenders such as CDFIs that traditionally do not engage in marketing activities. Innovation in the area of small business lending is improving access to capital. However, a number of issues still negatively impact this market and place the borrower at a disadvantage. To that end, I proffer a few recommendations to further remove pain points for small business borrowers and lenders. First, I strongly encourage the IRS to automate the 4506T process for a third party to obtain a tax transcript. Congressman McHenry and Blumenauer, as well as the ranking member of this committee, Congresswoman Velasquez, introduced H.R. 3860, the IRS Data Verification Modernization Act of 2017, requiring the IRS to automate the Income Verification Express Service process by creating an API, or Application Programming Interface, which would reduce the paperwork and the waiting period that currently burdens lenders and borrowers alike. Second, working with the New York Business Development Corporation, we've identified an opportunity to increase referrals of those borrowers unable to gain access of credit through traditional methods to a mission-based nonprofit lender by providing Community Reinvestment Act, or CRA, consideration for referrals. Currently, banks do not receive CRA credit from referring borrowers to CDFIs or other qualified institutions when these loans are too risky for the bank to underwrite. Given the economic development missions of CDFIs to support small businesses, a successful referral from a bank is something that regulators should incentivize. Third, the law should allow credit reports to travel with referred loan applications. When applying for a loan, numerous credit inquiries occur from the various lenders considering the borrower's request, even though the borrower is seeking a single loan. Currently, each lender has to pull a credit report, even if the loan is a referral. The more inquiries, the greater the impact on a credit score. As a credit score gets lowered, the cost of capital increases and becomes more difficult to obtain. Finally, I'd encourage to further incentivize the SBA to improve their technology in making the agency's lending process more efficient and borrower-friendly. SBA-backed products remain a vital source of capital for small businesses, particularly newer businesses and startups. However, the process and technology used are cumbersome and can deter many lenders and borrowers from participating. The private sector, including Mirador, has developed world-class matching technology, ensuring that borrowers end up approved by a lender under the most appropriate terms and conditions. The SBA should be encouraged to look to the private sector for technology solutions to improve the borrower experience in their flagship programs, SBA One and SBA Lender Match. Once again, thank you so much for this incredible opportunity, and happy to answer your questions.
Super. Thank you, Mr. Dreyer. We appreciate your testimony as well. And I think for the questions, I'm first going to yield to my colleague, Mr. Luke DeMeyer. He's got a special interest and expertise in this area, and he'll lead off with some questions.
Thank you, Mr. Chairman. I appreciate the opportunity to be here today in your committee. Ms. Fisher, I'm kind of curious. You are advocating or represent anyway the merchant cash advance folks. Is that correct? Would you describe a cash advance as a loan or an investment, or how would you classify that?
Sure, thanks for asking that. A merchant cash advance is not a loan. It is a purchase of the right to receive future income from a business. So a small business owner can enter into a transaction with a merchant cash advance funder under which the small business owner sells a percentage of its future income. And the merchant cash advance company then will receive that portion of the small business's revenue as the small business makes the revenue. It's a very helpful product for small businesses in that payments are not unconditionally required. The payments to the merchant cash advance company are required only to the extent that the small business actually creates revenue.
Okay, fantastic. So I know that in Mr. Phelan's testimony, he talks about a smart box, and I'm all for disclosures. I think the individual, the business needs to know what they're getting into. I think it's important, but I know in the smart box there is an APR disclosure. How do you disclose an APR with a merchant advance product?
That's a good question. A merchant cash advance product is not an appropriate.
It's not a loan, so therefore you don't
That's
really
right.
have an APR.
And also there is no definite term. So
Okay.
because a small business is required to deliver a portion of their receipts as those receipts are created, we can't know when those receipts will be created, and things can happen. Like there can be a tough winter in Minnesota, and business slows down for businesses there, and so receipts trickle in more slowly than expected. So putting an APR as a measurement on a transaction with no definite term is not the most helpful.
We're trying to fit a square peg into a round hole, aren't we?
Yeah.
You know, I deal with a lot of small dollar lending, and I chair the Financial Institutions Subcommittee and Financial Services, and so I deal with this stuff all the time. And it's, you know, for a long time, I actually chaired the Financial Services Committee back in Missouri when I was back in the State House, and I've always dealt with the problem with APR disclosures for small dollar lending, anything less than a year. You know, APR, the letters stand for annual percentage rate. How do you have an annual percentage rate on something that's not an annual payment, or it's not done on an annual basis? It's done for 2 or 3 weeks or 6 months at a time. I've really struggled with this, and I think, you know, quite often the APR is misrepresented, because at the end of the day, if I've got a leaky faucet at home and I call my plumber up and he charges $50 to open the, you know, to stop by my doorstep, goes in and says, oh, you got a tap I just got to fix. So within 5 minutes, you know, 10 minutes there, he fixed my faucet. Now, did he charge me $50 to stop by and pay for his trip out and his experience and all his tools and all of that, or did he charge me $300 an hour? That's the disproportionality of an APR and the misrepresentation of what's going on with a service charge for small dollar lending, which, you know, in your situation here, quite frankly, probably didn't even apply because of the business model that you have. So that's my concern with APRs. I think for small dollar lending or anything that's less than a year, I think it's an irrelevant thing, and I hope that can be something that the smart box can be able to be fixed so that it doesn't do more harm than good, because I think it misrepresents what's actually going on there. Mr. Dreyer, you made a comment a minute ago with regards to credit bureau inquiries. I think this is a very, very important point from the standpoint that the more inquiries that an individual has or businesses has, at some kind can have a negative impact on that person or that business's ability to get credit. Would you like to elaborate on that just a little bit?
Sure.
It seems counterintuitive, because you're trying to find a way to help people and actually hurt them by going to the credit bureau.
That's right. We see typically, because of the rules that don't allow one lender to share a credit report with another, that small businesses often have to apply to several lenders in order to find one that they fit their credit parameters, their lending parameters. And so you'll see sometimes when they're looking for the same $50,000 loan, they've had to apply to 5 or 6 lenders, and as they go through the process, more credit inquiries, lowering their FICO score.
So how would you fix that for your small businesses? Because this is really important, because they're trying to get started, they're struggling, and yet if they actually try and go someplace and get some funds, and that individual or company or entity goes to the credit bureau, it's actually a mark against them. How do you solve that problem?
I would solve it by allowing the credit report to be transferred from lender to lender. If you're applying for a single loan, even if it's in multiple lenders, that should be one credit inquiry, in my view. And if you can allow the borrower to kind of take that data with them, that would, I think, solve largely the problem.
Appreciate that. Thank you, Mr. Chairman. My time's expired.
Thank you. I'll now yield to the ranking member Mr. Evans, for 5 minutes.
Thank you, Mr. Chairman. Ms. Fisher, I want to probe a little bit more on what my colleagues just talked about. When applying for finance, does your industry get personal guarantees that lenders and other industries receive?
Yeah, thank you for that question. In the merchant cash advance industry, there typically are personal guarantees, but they're of a different sort than with a loan. As I explained before, with a merchant cash advance transaction, the business is only obligated to deliver revenue to the extent the business creates that revenue. So the personal guarantee is not a personal guarantee of payment. The business owner also makes certain promises, such as they won't divert revenue. They won't open multiple bank accounts and do funny things with their money. So the guarantee is a guarantee of those types of promises, not the guarantee of repayment.
So does that lack of collaboration affect your business model?
No, I think it affects it in a positive way in that it helps only ensure that the business owner, who typically is the person who can control in a small business whether they're opening multiple bank accounts, is standing behind those promises. But it doesn't change the nature of the product being not absolutely repayable.
Mm-hmm. This is to the entire panel. I'll start with you. Are you aware of the Small Business Borrowing Bill of Rights, and do you think its tenets include common sense tools to protect small businesses and provide transparency?
Oh, thank you.
Start with you, Neil.
I am aware of the Small Borrowers Bill of Rights. I haven't read it in a while, so I'm not familiar with exactly what it says. I think that, as I recall, there are certain things about it that are very good. There are certain things about it, I think it mentions APR, so that would be something that I would disagree with. The good news is there are many different industry groups who are working on best practices. And although they don't agree with every practice, they are working hard on coming together for best practices as a whole. So that's a positive thing.
Okay. Other people want to respond to that?
Sure, yes. Thank you, Congressman. We also are aware of all the different disclosures that are underway now in the industry, and I mentioned some of them in my opening remarks. And there are different tools for assessing the cost of these types of loans. We think that more of those tools that are made available are better for the business to assess. I think somebody here mentioned that businesses have all kinds of credit needs and financial needs, and it's hard to distill this down into any one kind of point of view that can encompass all these different capital needs or credit needs for businesses. And so providing the disclosure and having the tools available make a lot of sense as a way to help clarify the cost for the business.
Yes, we applaud the efforts of the industry to create more transparency and disclosure. At the end of the day, that to me is what's important, is the small business understanding what they're getting into. I think the challenge is when you have regulated entities that are subject to regulations requiring a certain disclosure, and then you have industry groups that have taken a different approach, it can become very confusing for a small business if they're looking at multiple lenders to really understand the true costs and the terms of the loans. And we see that can be quite confusing. I don't have a great solution for that, but I think the more that a small business can be allowed to compare proverbial apples to apples, the better it is for the borrower.
Thank you. Mr. Chairman, I yield back the balance of my time.
Thank you, Mr. Evans. I think we're actually doing all right on the voting clock. They're still talking on the floor, so we've done well today. I'll ask a bit of a technical question, and then in the back of your minds, you're up here in D.C., federal government, federal law, et cetera, regulations, at the end, maybe just suggest how we can be helpful to you moving forward. What can we do better and that? But I'll just start off with more of a narrow question. We'll just start with Mr. Phelan and work down. Currently, the Consumer Financial Protection Bureau, CFPB, is in the process of implementing Section 1071 of Dodd-Frank, which would require financial institutions, including online lenders, to gather and submit demographic data of borrowers to the government. What concerns, if any, do you have with this provision, and how would it affect both small financial institutions and small businesses?
Thank you for that question. Yes, we've worked a little bit with the CFPB to help them understand this data collection requirement. It's complex, and what we find is that the data doesn't exist today, so it's hard to say where exactly to go for it right now. We think that the challenge is in creating this massive set of information, and that it's going to put a burden on the businesses ultimately to report this in the transaction. And so there will be some requirements to collect it from the business. It's really the only source to get it is directly from the business, because no other sources exist right now. Then you've got the challenge of being able to create this massive data warehouse, and there's different ways to do it. What we've spoken with the CFPB is to utilize current technology right now that exists right now to collect this information. Once that's collected, it has to then be crafted into finished product that can understand what's going on in the lending markets and to understand fair credit, lending activity. So the concerns are it's going to be a massive project. It's going to be a very substantial initial change for both the business all the way through, I think, even to the CFPB to finally get understanding out of this data set.
Great, thank you much. I apologize for the fire alarm. I've never heard it go off like that before. But I think I'm going to yield my time to member Yvette Clark from New York right now. She's with us, and I want to make sure we get her questions in if she has any for you today. Thank you.
Certainly. I thank you very much, Mr. Chairman, and I thank Ranking Member Evans. I thank our expert witness for appearing here today. We know that the world has changed dramatically over the past decade alone. We've seen rapid technological advances that have allowed us to access the world in the palm of our hands. However, we have also seen generations of family wealth wiped out through the mortgage foreclosure crisis. At the center of all of this lies the financial technological industry. This crucial industry offers the promise of easier access to capital for people to open businesses, afford college, and launch new products. However, it also means that lenders could be exposed to new forms of fraud, and borrowers could face new forms of soft discrimination, implicit bias, by focusing on non-traditional lending factors that structurally disadvantage specific communities. Our goal as elected representatives of the American people is to ensure that the government creates clear, fair, and effective rules to maximize access to capital while minimizing risk and discrimination that results from bias. So my first question is to Mr. Phelan. Can you please describe what non-traditional factors fintech lenders may look toward in making investment decisions? For instance, is there some means of explaining the story behind late payments within the confines of your application process?
Thank you. Thank you for that question. First of all, I'll start with just the nature of a small business. A lot of times small businesses lack the financial statements in an audited format. And so they start with they don't have the need to present audited financial statements and undertake all that expense that a public company does. And so, that is the starting point. And with that starting point, lenders are looking to do a credit assessment. They're looking to conduct an assessment about the ability to repay the loan. So if you put those two together, and immediately you have to go to some sources of data to assess the credit of the borrower. And these sources are things that are mentioned in the memo. Things like credit bureau information is one source, both on the personal and the commercial side. So there's commercial credit data that can be used very effectively. Secondly, there's very creative things done by the fintechs around collecting financial statement or financial cash flow information through the bank statements. And so they can actually look at the cash flows of the business through the bank statements. So there's these things. There's other sources that are, I think, been more hyped than reality, things like social media that are interesting from a credit assessment standpoint, but are unproven. And so I think those are challenges that have not really been fully vetted yet. And then there's other forms of payment records like the short-term trade payable information. So shipping bills, phone bills, light bills, things like that. And so you can, I think what's interesting about this perspective is that, the online lenders really never see their applicant. They don't meet them face to face, which is far different than the community bank structure. Mm-hmm. In the community bank, you walk into the branch, you meet the banker face to face, and with the online lenders, this is all done online. It's all done really through the information and the data that doesn't provide that view into the business itself and some of the characteristics, other than you get name, address, phone number, name of the business. You get then the payment records and maybe some public filing information. Mm-hmm. And so that can be distilled down to create some very credible and reliable credit assessments.
Very well, thank you. Ms. Fisher, in your prepared testimony, you went into detail about the complexity of merchant cash advances, which allows for businesses to sell their future receipts for cash upfront. Yet you also claim that they are already sufficiently regulated at the federal and state level. Are there any changes that you would like to see made to the way in which the government regulates MCAs?
Thank you for that question. My view is that federal regulation of merchant cash advances is sufficient. There are federal laws that touch the merchant cash advance transaction, as I mentioned, throughout the transaction from marketing to underwriting to servicing and collection. So I don't have any suggested changes. Thank you.
Very well. Mr. Chairman, I yield back. Thank you.
Thank you very much. And sorry for the rush field today. I apologize. We usually, on fly-out days, we usually leave about noon, but today, for some reason, it happened a little early. And so I just want to thank you all for your participation and good spirits today and the excellent testimony you all provided. I ask unanimous consent that members have 5 legislative days to submit statements and supporting materials for the record. Without objection, so ordered. This hearing is now adjourned. And don't worry, when you see we have 8 minutes, we really have 23 minutes. So that's how it works up here in the swamp.
Thank you. Thank you.